we have someone who will add much more greater perspective on our market narrative which we are holding on our channel because of the sheer size of the assets under management running into several billions of dollars, and also the time spent in the market. I'm talking about Mr. Manish Kumar, CIO of ICICI Prudential Life Insurance. Over 30 years, he's been around, seen many a cycle. Manish, good afternoon. Thanks so much for your time. Let me, dig a little bit out of your rich experience. You've seen many booms and busts, tough time for the economy. This particular correction which we saw, October onwards, 8th, 9th month in a row, we are in a corrective kind of a phase. New worries kept on erupting. Earlier it was pure valuation, then the war, now macro worries, all of that, high inflation, stagflation. Right now, when you look at the market, what are the key challenges which you see in this market, which is still not in the price? Because all the things which I spoke about are being discussed quite nicely in the market already.
Good afternoon, Ajay. Thanks for giving me this opportunity. A pretty long question, so let me try and address in the interest of your viewers. As you rightly pointed out, yes, a lot of things seem to be in the price. Our view itself has been that with this leg of correction, at least one big leg of correction as far as the index is concerned has possibly happened. What is possibly not in the price is the fact that US Fed will keep on tightening for the next 2 or 3 meetings, and therefore while we may see bounces in our markets, the chances are that the foreigners will continue to sell. So if I may give some more perspective, in the last 1 year or so, as we all know, FIIs have been on the selling side, matched equally by the domestic buyers. Now, there have been multiple reasons for that. One is, of course, US Fed tightening. Second has been that Indian markets have been one of the outperforming markets in the region. And third, some of the competing markets have been cheaper on valuation terms, in valuation terms. So for these reasons, we have been seeing selling. And those reasons, while they may have abated a bit, they have not completely gone away. And if we look at the overall construct of the market, there are still certain pockets where the valuations, while they may have come off, they're still quite rich. And those pockets, we may want to be careful. But if I look at the broader index, and within that, if I look at certain space like the financials space, there the valuation correction has been pretty significant. The valuations look pretty reasonable, and one can actually look to invest systematically.
Manish, how do you read the US inflation reading? The subsequent one came slightly dipped, on the lower side, and even India inflation reading last evening. Does it give you a sense that peak of the inflation may have already been made, or you would want to wait for the data points in coming months a little more before taking that view?
Well, optically, peaking may have happened, but I don't think central bankers are only looking at that one optimal, that peak level of inflation. They are looking at the structural construct of inflation. And if you look at the US data, since you started with that, see, the number may have come down by about from 8.5 to 8.3%, but core inflation still remains sticky. And from manufacturing inflation, we are now seeing transition to services inflation. So it is not about a particular data point, it is about the broader trend. And we believe that whether it is the Indian CPI print or the US inflation print, even if it may come off a bit, it is still much above the comfort zone of the central bankers. And therefore, one should expect both the central banks, US Fed as well as RBI, to continue to tighten going forward.
Will it be right to look at, assess the risk reward in some of the areas which took the brunt of highest inflation on the material side, crude, metals, all of that, or even like banks have really, like autos and capital goods margins, and even some consumer spaces, margins have been severely under pressure. Then banks also, in a way, have been seen big drubbing. Do you think that may reverse, and that's a pocket of interest for you going forward?
You are absolutely right, and that is what I was also suggesting, that while index as a whole may not see a significant rally from here because of what the central bankers are doing, uh, and there are pockets of expensive zones, yet there are also pockets of markets where the valuations are looking quite reasonable. So the entire financial space is one such pocket. Another space is commodities. Commodities actually, um, in terms of price correction, they have seen a significant correction in the last 3 months. But if you look at the last 2 years, they are still much above what they were 2 years back. But I think it will be wrong to look at commodities in terms of just the market price or the market valuations, because most of the commodity companies have deleveraged significantly. Therefore, the enterprise value of these companies actually may be similar to what it was, say, 2 years back, when the market prices were a fraction of what it is today. So they are significantly stronger in terms of balance sheets. And even if one were to assume some kind of mean reversal of their profitability, yet some of them are looking quite cheap.
Right. Manish, what are your thoughts on broader markets? Because that is where a lot of people started witnessing froth emerging. Broader markets, small caps in particular, have traditionally, traded at a discount to large caps. They had gone into a premium zone. After the brutal sell-off last few weeks, do you see value emerging in broader markets or not yet?
Parts of it, yes. So there are places in the organized retail space where we are liking some of the companies. Likewise, as I said, in commodities also, some of them in the mid cap space also we are liking it. Some of the companies are in the logistics space that we are liking. So parts of the market, yes. There has been a sizable correction in the fintech space, and maybe we'll see some kind of reversal there as well. But our belief is that wherever the positions are heavy and the retail participation is higher, I think those pockets will continue to see correction going forward. Whereas those companies or those stocks which have been hammered by FIIs, that have been on the receiving end, probably we'll see better valuation comfort in those stocks.
Last question, Manish, from you would be on the quality of earnings which are coming in. After several quarters of one-sided outperformance and upgrades, last 2-3 quarters, numbers are being trimmed. In fact, this quarter too, we are seeing some margin pressure for most of the companies. What are your thoughts on the earnings growth possibility, even if we take a 3 to 5 year view? What kind of range do you see is possible by corporates?
So let's talk of first the immediate next 1 or 2 quarters, and then probably the next 5 years. So you are absolutely right that even going forward, as the companies will report for the June quarter or the September quarter, many of those companies are likely to show margin compression. Of March, because of the Russian-Ukraine war, and also in general because of the abundant liquidity that has been prevailing around. So to that extent, in the near term, the companies will report margin compression, and to some extent there could be margin downgrades, and there could be some earnings downgrades. But if I have to take a 3 to 5 year call, I think Indian companies are headed for a fairly robust earnings growth trajectory. I would say somewhere in mid-teens, and I'm in fact I'm inclined to say that I am more positive from a medium-term standpoint than I was in the pre-COVID era. And there are some very simple reasons for that. If you go back to the pre-COVID era, there were very few sectors that were participating in growth, and those were the only sectors that were contributing to earnings growth. So I would say some of the private sector financials, the consumption space, and so forth. Today, this economic growth is far more widespread, and there are many more sectors that are participating. You look at the real estate, you look at the organized retail, you look at the entire commodities space, hospitality, so many sectors are actually participating in growth. So that way, I'm far more positive here. Second, the balance sheet of almost all the companies, be it in the large cap space or even in the MSME space, seem to have improved significantly in the last couple of years. And actually, that also means uh, much less problem for the banking sector. In fact, I may want to add here that not just the companies, but even if one were to look at the balance sheets of the households, I would like to believe that their balance sheets have also improved. So overall, once again, good news for the financial space. When we look at the financials of the government, that is also looking quite healthy. The GST collections are running at an all-time high, which means we can look forward to a very stable taxation regime. So overall, I would be quite positive on the Indian economy and markets from a medium-term perspective.
Right, Manish, we'll let you go on that one. Thanks so much for adding perspective in the discussion today. Time for a short break. On the other side, we'll put the spotlight on specific stocks and why they're buzzing in trade, why you need to keep them on your radar. Don't go anywhere.